Welcome everybody. Today we're going to be talking about the retirement bucket strategy, which is one of the more common distribution strategies that retirees can plan to use. We're going to be going into how it works, why you should consider it, and a 5-step process of implementing it on your own. At its simplest, the retirement bucket strategy is a method of splitting apart your retirement funds into 3 different sections that are earmarked or detailed by the length of time at which you'll need to access them. So you'll have a short-term bucket, which is for immediate or immediate-like access, maybe between years 0 and 5 in retirement. You'll have an intermediate term bucket that is for, let's say, between years 6 and 10, and then a long-term bucket for years 11 plus. The idea behind this strategy is it can clearly visually represent and delineate between the levels of risk and the types of investments that would go into each bucket, and therefore possibly give you more permission to spend money and understand where to draw money from if there are, let's say, bad market events or personal circumstances that require more than the estimated amount of funding that you might need. So if you're new to the channel, welcome. So happy to have you join us. My name is Eric. I am the head financial planner and owner of Peak Financial Planning. And we help people just like you all over the country ensure that your money outlives you by making smart investment and financial decisions, including going through things such as the retirement bucket strategy, so you know if it's an appropriate fit for you, and if it is, how do you use it? So before we jump in, if you like videos like this, please give this video a like on YouTube and subscribe to the channel. You'll get served more videos just like this. Share this video with a friend who could use this type of information. And let's jump right into discussing the retirement bucket strategy and how you can implement it. Let's begin by taking a deeper look into the different buckets. You'll have a short-term bucket, which is earmarked for cash or cash-like investments. Now, it's up to you to determine how many years you'd like to put into that bucket. And the way you'll make this determination is by having an understanding of your expenses or your required portfolio income in retirement. Because what you're going to do in the short-term bucket is put cash or cash-like investments in. We're talking things like treasury bills, 1 to 6 month treasury bills, money market accounts, certificates of deposits that are less than 6 months in length, high yield savings accounts, or just pure cash. And you're going to have to assign a value to that bucket, which means that you're going to take some money out of portfolio assets or invested assets, and then you'll use the balance of those assets to fund buckets 2 and 3, which we'll go into in a second here. So bucket 2 is going to be your intermediate term bucket. Let's create an example here and we'll put some numbers on the screen as we go. But let's say this intermediate term bucket was going to be put funds in there that would be accessed 5+ years out. So it might be funds that would be used for years 5 through 10 of retirement. Because those funds would be used later, we can take on slightly more risk. We can look for an investment rate of return that is slightly outpacing inflation or just matching inflation. It's still conservative, but it's more risky than leaving things in cash or cash-like investments. And we know it's a good psychological tool because we know that this money is going to be invested, but conservatively, and we'll assign it a specific percentage or proportion of our investable assets. And you'll see how that comes into play when we go into bucket 3 and then actually construct a bucket strategy on the screen for you here. Now, bucket 3 would be your long-term bucket. Let's say this would be earmarked for funds that would be needed 11 or more years out of your retirement target. And because those funds would be needed so much further out on your timeline, you can therefore take on more investment risk. And time will smooth out the volatility that comes with taking on more investment risk. So this bucket would have investments in it that would be something like growth stocks or corporate bonds or high yield bonds or emerging market funds. And the intermediate bucket, which we talked about just a second ago, which is your more conservative but still invested monies, might have things like government bonds or dividend stocks or real estate investment trusts. Now, in a second here, we're going to talk about how would we actually assign the buckets different values based on a starting portfolio value, and how would we think about the investment selection within them. The first step in actually building out your bucket strategy so that we actually know how much we need to put in fund each bucket with is to make an estimate of your required portfolio income in retirement. Now, I have other videos that go into the exact method of calculating that. I'm not going to do that on the screen right now, but you can go watch this video on the top right here that helps you estimate how much money you need for retirement and also calculate how much of that will be generated by portfolio assets. But for this video, let's assume you already have an estimate of how much you'll need in portfolio distributions each year in retirement. You will then use that number to construct the funding amounts for each bucket. So for the short-term bucket, actually, let's use an example here and say you have $1 million of investable assets at the point at which you retire. Now we can go and assign funding goals to each bucket. So with that $1 million, let's say that first bucket is going to have 5 years of expenses or 5 years of required portfolio income in that bucket. So we would want to assign 5 years of cash or cash-like investments to that bucket. Let's say your required portfolio income is $20,000 per year. Well, bucket number 1 will have $100,000 of cash and cash-like investments in it. Now, buckets 2 and 3 are going to get assigned their funding goals based off of an asset allocation, not based off of a cash need. So let's say we assign an asset allocation to this person or this individual of 60% risk and 40% conservative. Now, your asset allocation will be unique to you. I highly recommend consulting with a financial advisor, fee only, and fiduciary, so you can actually understand how to quantify your asset allocation and the risk levels and trade-offs associated with that. But for today's video, let's just assume you're going with a standard 60-40 portfolio. Well, you have $900,000 is the balance of your investable assets separate from what's in that first bucket. So we would put 40% in bucket 2, which is $360,000. We would put 60% in bucket 3, which is $540,000. Now, within those buckets, you would have to actually construct an investment portfolio that supports the risk level. So if you add that 40% of conservative investments, we would need investment selection that is consistent with that. And those funds in that middle bucket there would be invested such. Same thing for the longer term bucket. Those funds would be invested consistent with that 60% risk target. And then what we would do from there is assign some monitoring goals. We need some benchmarks with which to track our different buckets and their performance, because the investing is a dynamic process. We need to be able to adjust and react to changing market conditions or changing personal circumstances. And the best way we can do that is if we have some kind of metrics we're tracking. I favor tracking things such as your required rate of return as dictated by your financial plan. So what I mean by that is, in your 40% bucket, you'll need to get a certain rate of return that, when combined with your 60% bucket, allows your funds to last for the rest of your life and meet all your funding goals, including beating inflation over time. We'll need some kind of rate of return in order to achieve that. The financial plan that you do will actually model that and share with you what that rate of return or percent rate of return is. It's not super useful to compare your 40% or conservative, middle bucket there to the S&P 500 index. They're not actually comparable investments. And so we need something else to attach or benchmark that middle bucket too. And that's where your required rate of return from your plan can come in handy. Now, what we really want is separate required rates of return for each bucket. That cash bucket will have its own. You're probably not going to have a rate of return for that because it's cash. You'll have a rate of return for that middle bucket that is consistent with the risk profile assigned to it. You'll have a rate of return with your most risk tolerant bucket that is consistent with that. And then what you'll have is an overall blended rate of return. And what you do is you track that over time to make sure you're tracking along that trajectory and meeting those expectations. If you're not, we'll have to do some adjusting to the investment selection or the portfolio construction. And if you are, then you can do some rebalancing and pruning and maintenance to move funds, let's say, from stuff that has outperformed into things that have underperformed, or move funds from things that have underperformed to things that have outperformed. This rebalancing process for buckets 2 and 3 would look something like this. Let's say you assign a 40% portfolio value to bucket 2 and 60% to bucket 3. Well, those dollar amounts are going to shift and change over time because we do hope that those buckets grow. Well, if after 5 years, bucket number 3 is now 64% of your investable dollars and bucket number 2 is now 36%, just because bucket 3 outperformed and outpaced with growth, well, you would want to perform a rebalance and shift 4% of the funds from bucket 3 back to bucket 2, because you don't want your long-term bucket to end up becoming such a high proportion of your total investable dollars that more of your wealth is sensitive to market volatility. Obviously, with more risks comes the greater increase of a potential drawdown, and you don't want to see a huge proportional drawdown, especially later in life when you need access to your funds or you're more time sensitive. This is a good place to start to wind the video down. The bucket strategy is not the only distribution strategy you should be considering. There are several others, including the 4% rule or systematic withdrawal method, and each of these is going to align with you based on your personal psychological profile. So you'll find yourself understanding and feeling comfortable with a different distribution strategy. There is no one size fits all. The reason I like the bucket strategy in general, some pros for it, are that it's very easy to visually represent what each bucket is earmarked for. And that can give you, the retiree, permission to spend. You don't have to worry as much if you know that this first bucket is all in cash and is earmarked for spending over the next 5 years. You just don't have to think and ask yourself, do I have permission to take money out of that bucket for things I've already committed to? Should the market be more volatile or go down or this or that? That money's in cash, it's been earmarked, and we've assigned rates of return that are consistent with your funds successfully, lasting the rest of your life. And that is what is important. So I like this strategy because it gives people permission and is easy to visually represent. The other part that's nice is you have separate required rates of return for different portfolio allocations, and it can be easier to track, especially when the money is held in different accounts, so that let's say you have an account for each bucket. Well, now it's a lot easier to track than one blended rate of return on a broader or larger account, which is hard to disentangle. Well, how are different investments performing relative to each other or relative to our initial expectations and targets? In closing here, your distribution strategy is one of the most influential parts of your retirement plan. And so picking the right strategy for you is very important. Now, I highly recommend finding a fee-only fiduciary financial advisor who can help support you in this, because even though we went over the broad strokes in this video, the truth is there's a lot of nuance to this method. You still need to have proper investment selection. You still need to rebalance over time. You need to track rates of return over time and how they're tracking or trajectory aligned with our required rate of return. So there's a bunch of things that are going on with this strategy. It is a very useful strategy, but again, I highly recommend working with a fee-only fiduciary financial planner or financial advisor who can assist you with the micro details of executing a strategy like this. I hope you found this video helpful. There are plenty other videos just like this on our YouTube channel at Peak Financial Planning that educate and guide on all the different elements or decisions you'll have to consider as you lead into retirement. If you like this video, please give it a like on YouTube, subscribe to our channel, turn on notifications, and share this video with someone who might be in a similar position and could benefit from watching this. If you have suggestions for other videos or other topics you'd like us to do educational guides on or just address, please put them in the comments below. And as always, thank you for your time and attention, and we'll see you in the next video.